AI is incredible. It can teach you how to fry an egg and even write a poem, pirate style. Yarr! But it knows nothing about your work. Slackbot is different. It doesn't just know the facts. It knows your schedule. It can turn a brainstorm into a brief. And it doesn't need to be taught. Because Slackbot isn't just another AI. It's AI that knows your work as well as you do. Visit slack.com/meet Slackbot to learn more.
With Sam's Club, you have the freedom to shop your own way. Curbside pickup? Delivered to your doorstep? Come in and grab it yourself? Yes, yes, yes. They've got plenty of options. Your call. Say yes to shopping the way you want. Join now at samsclub.com/yes and. You must be 18 years or older to purchase a membership, and membership is subject to qualifications. Visit samsclub.com/yes and for details.
You know, it's a great thing to do on a Monday morning. Start off your day recording early with leftover Santa Claus chocolates. You guys want one?
Eating Santa.
Yeah.
I was going to say, we're recording this just a smidge early, and apparently whatever it is that you do on New Year's Eve is the thing that you're going to do the whole year. So cheers to that, everybody.
Oh boy. What's in that coffee?
Drinking alone, OG? Is that what you're going to do for the rest of the year?
Podcasting is what I was saying.
He's got two friends here with him watching him drink. Oh, podcasting. Gotcha.
Mine's out of the gutter.
You know what else we're going to do all year long? We're going to begin our Monday shows by saluting the troops. On behalf of the men and women at Navy Federal Credit Union and the men and women making podcast in Mom's Basement, here's to the people who helped us all over the holiday. Stay safe and through 2025. And I know it's going to happen in 2026. Thank you so much. Let's go stack some Benjamins together now, shall we?
Thanks, everybody.
Here's the song that we'd like to do for all the younger set of people, the teenagers and what have you. This one's called Vacation's Over. Vacation's over. It's over. It's over.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and let me be the first podcaster to welcome you to a new year. Did you miss us last week? Well, we're back for 2026 and better than ever. Let's kick off this shiny new 12 months with some headlines ripped from the press. Problems in real estate land? Scam companies people are tricked into investing in? Yup. New year, old problems, and we'll tell you how to keep your portfolio upright and rolling toward better times. You want more? Okay, we'll bring it. I'll also keep the real estate theme rolling with our TikTok Minute, and just when you thought that was all we had, I'll amaze you with a spoonful of share-worthy trivia. And now, two guys who have already forgotten 2025 because they are so 2026, it's Joe and OG.
2025, is that even a thing? We are so over it. We're so absolutely over it. Hey, everybody. Happy New Year. Welcome back to the Stacking Benjamin Show. Super happy you're here with us. I am Joe Saul-Sehy, and I'm joined every Monday, Wednesday, and Friday by this gentleman across the table from me. Mr. OG is here. How are you, brother?
I was just thinking that my wife's grandfather just celebrated his 99th birthday at the end of last year in November. And he was born in 1926. And you think back from like 1900 to 1926, and you think like that is so much time. It's so much time ago, but like all the stuff that happened
those
in
26 years between 1900
years,
and I got it.
Yeah. And that's basically where we are in the 2000s.
Oh yeah.
Shut the hell up.
And everybody here is like, yeah, 2000. That was like, 4 days ago. We just, So we are a quarter century into this century. That's wild.
How do your goals change when you're 99 years old? Are you like, I just got to make it another 12 months. Like, I just got to see the 3 digits, man. I got to watch that odometer roll.
He's in great shape. He's physically, there's some things going wrong, but mentally sharp as a tack and lives on his own still and everything.
That's great. Cheryl has a 96-year-old uncle who's the same. Just Super sharp, fun to talk to. When you talk to him, in fact, you forget he's 96.
Yeah.
You totally forget. It's amazing. Well, guess what? It is 2026. And while we are getting days older than we were just a few days ago.
You should have some short-term goals. You should have some 2026 goals, but maybe 27 and 2050 as well. Even if you are 99, the hell with it. You might as well have some 2040 goals. Why wouldn't you?
You absolutely should have 2040, 2050 goals. Come on. The theme today is it's a new year, but the old rules still apply. If you're wondering what the heck I'm talking about, same rules going to apply in 2026 that applied in 2025 and before. And I bet Mrs. OG's grandpa would say same rules that applied in 1947 or 1962, whatever it is. Also, finally, the team you've trusted with your money talk has created a product to protect your credit, your identity, and your privacy. You know how much OG and I like talking about insurances and emergency funds, and that's why we're locked in. Someone today is having a really, really bad new year because their credit's wrecked, their identity's been stolen. Well, the Stacking Benjamins Vault, love saying those words, does so much more than that. Run what-if scenarios before big purchases that affect your credit, cut unnecessary subscriptions, get off dark web lists. We built it for us, but you can get it too. We call it the Stacking Benjamins Vault. Go to stackingbenjamins.com/vault to take control and lock down your financial life. stackingbenjamins.com/vault gets you there. Super excited about that. That is new for 2026, the Vault. Things that aren't new are people scamming you on your money, people telling you can get rich faster. And that's the topic today we're going to dive into. So we're going to hear from a couple of our sponsors who keep things rolling here in Mom's basement. And then after them, OG, Doug, and I going to dive into what's new is old and what's old is new. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we change it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier because with their expertise, their helpful tools, and their easy to use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-to-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB. Spring cleaning's made its way to my closet. This time of year always makes me rethink exactly what's in my closet. Really want to keep fewer things, but I also want to keep better ones. I want to feel confident, and to feel confident, looking the part's a big piece of that. So I want pieces that are well made and that are easy to wear all the time. And that's why I keep coming back to Quince. The fabrics feel elevated. The fits are thoughtful. Pricing actually makes sense. As I'm swapping out and I'm cutting, the few additions I'm making all come from Quince. Quince makes high-quality, everyday essentials using premium materials like 100% European linen. They're insanely soft, flow-knit activewear fabric. Their men's linen pants and shirts are lightweight, they're breathable, they're comfortable. Basically, the perfect layer for spring. The pants strike the right balance between laid back and refined. If you saw the video of me on stage at Retire Meet, those pants are from Quince. It was really cool. I came off stage and Christine Benz from Morningstar getting ready to go on behind me and said, "Love your pants." Not generally. I absolutely love them. I think they make me look put together without trying too hard. And they're Flownet activewear, moisture wicking, anti-odor, soft enough that you'll actually want to wear it all day. The best part is their prices. This is important, stackers. They are 50 to 60% less than similar brands. How? Quince works directly with ethical factories, cuts out the middlemen, so you're paying for quality, not brand markup. Everything's designed to last and make getting dressed easy, which is another thing I think we all want. I love those pants that I wore on stage. It's the cashmere sweater that every time I wear it, Cheryl goes, "That is my favorite sweater on you." It looks great, feels great, and I don't have to have 50 things in my closet. So, like I am, refresh your wardrobe with Quince. Go to quince.com/SB for free shipping and 365-day returns. Now available in Canada, too. Go to QUINCE.com/SB for free shipping and 365-day returns. Quince.com/SB.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Our headline today comes to us from the Wall Street Journal. This is written by Jonathan Wheel. How a push for more IPOs fueled a wave of scams. Can you believe that, OG? IPOs, initial public offerings, for people that don't know what that are. These are new, well, not necessarily new companies, OG. These are just companies that are new to the stock market that people can invest in. That's what an IPO is.
Yeah, it's instead of it being privately held, now it's available for public sale.
So the government got involved. We're here from the government. We're here to help, of course. So here's what the government did to help us all. U.S. government has tried to address the long decline in stock exchange listings, fewer and fewer companies being listed publicly, by relaxing the rules for small public companies. So it gives us more opportunities, OG, gives us more options in companies to invest in. But this approach creates a persistent risk, more stock scams. The commissioner of the SEC, Paul Atkins, is pushing to further ease the reporting obligations for many smaller companies under a 2012 statute called the Jobs Act, which gives special treatment to, quote, emerging growth companies. So if you call yourself, OG, an emerging growth company, you are likely
I'm sure it's more than just you calling yourself. There's probably some amount of rules around.
You don't just get to call yourself, hey, guess what I am?
Yeah.
We are now a crypto podcast. We have our own NFT. Are NFTs still a thing? Do those exist anymore? Is that a deal?
Like all the monkey ones? I bet you can get them cheap.
Yeah, you might be able to score a deal on those. The law gives special treatment, though, to emerging growth companies. So, but at the same time that Atkins OG is trying to encourage emerging growth companies, he's also leading a fresh attack on stock frauds targeting individual investors. Listen to this. Since late September, the SEC suspended trading in 12 companies' stocks, which is more suspensions than in the previous 4 years combined. The SEC cited potential manipulation that appeared to be aimed at inflating the stock prices and volume. This is a big thing, especially I think with new investors, and we're seeing the Robin Hoodification of stocks, OG, where it becomes, betting. Some companies, which truly aren't companies, these are just people who are like, hey, let's take advantage of the fact that people just want to bet on the new hot thing.
Reminds me, it sounds like anyway, like penny stock stuff. Is this kind of what it is, maybe? Or
all 12 companies are, quote, emerging growth companies, classified. To your point, they follow all the rules in the Jobs Act from 2012, but they're not American companies. This is the wild thing. All 12 of these companies that were suspended, based in Asia, 4 in Hong Kong, 1 in China, 10 went public this year and 2 last year on the NASDAQ. All 12 initially went public, OG, you nailed it, as penny stocks.
Well, the interesting thing, I think what people misunderstand with low priced shares, penny stocks or something, when you look at it and you say, oh my gosh, the stock is trading at a nickel, I can buy. All it's got to do
is go to 10 cents.
Yeah, I can buy, $1,000 worth. And if this thing goes to $1, I make a gajillion dollars. While that's true, the math is the math. There's a reason that the price is where it is. My brother worked in a stockbrokerage company years ago and had a client at his branch. It was a kind of older days when people would come to the office to do trades and that sort of thing. But anyways, he had a customer at his branch that was buying this penny stock because he had the same idea. Like, oh, this stuff's like a nickel. Like this is almost like fun money. It's gambling, right? Like if I put $5,000 into a slot machine or $5,000 into a penny stock, I probably have the same outcome potential. Fast forward some time and the stock actually did appreciate a little bit. It had gone from whatever, and on paper he had made a pretty good profit. So he came in, he says, I want to sell my stock. And my brother got to tell him, I'm sorry, sir. You are now a majority owner of the company.
Oh my goodness.
You are required to file public disclosure forms before you sell your stock because he was buying so much of it that he was over 10%.
Do you know what the total was? The total amount of money?
I don't remember. It was in the tens of thousands of dollars.
Not in the hundreds of thousands.
No, it's not like he wasn't Warren Buffett, owning 10% of American Express or something. No. This was his own little thing. But his amount that he had put in was in the tens of thousands, and it was worth the hundreds of thousands. It had done, he bought it for a penny and it had rose to 10 cents. Well, basically he was buying his own float. He just saw it go up because he was the only one buying, and people were like, I don't know, see if he'll buy it from me for 2 cents. See if he'll buy it for 5. He was the only one buying. But anyway, so it had gone up, but now he was a majority owner, or not majority owner, but he was a big purchaser. And so now he had to disclose his sales in advance.
Imagine, I didn't expect this to go this way, OG, but imagine what you can do. Like when you become an owner at that big a level, there are some things you could start demanding things of management.
Yeah, I want to be on the board, man.
You see these activist investors. Could you imagine?
Like you own $7,000 of some Asian penny stock.
Right.
And you're like, I want to see at the board.
Who is this Joe Saul-Sehy from Vicksburg, Michigan, originally, and now in Texarkana, who owns 12% of our company? Leah, listen.
They're like, where we'll meet at Denny's on Tuesdays. It's BYOB.
I need a car allowance now because I'm a top shareholder and I got to get to all these different meetings, due diligence meetings about the stock.
Great news. It's fraud. There's no meetings.
When it comes to these penny stocks, it reminds me of, one of the first books that got Cheryl, my spouse, interested in personal finance was a book called Rich Dad, Poor Dad, which, OG, you've read. And I don't know, Doug, have you read Rich Dad, Poor Dad?
I have not.
It is a fine book, and I can see why it's lasted, because this idea of the rich dad, and should I say spoiler alert? Should people to fast forward if you're going to read? The book's been out forever, so if you haven't read it yet, just the big takeaway is the rich dad tries to accumulate assets while the poor dad works his butt off working for somebody else and being taxed very, very heavily. And never having any assets, really living a lifestyle where he's much more in the rat race. So he's learning from these two older gentlemen, these two mentor figures of his. I love that part of the book. The big problem with Rich Dad, Poor Dad, OG, that I have is at the end of the book, Robert Kiyosaki goes, so here's what you got to do. You got to invest in penny stocks because, you buy stocks for, to your point, 5 cents, and they go to 10 cents, like you could lose on 9 of them, but the 10th one's going to make up for all that. So just buy a bunch of penny stocks.
I read that book. I do not remember that being in the book, but maybe I just never finished it.
I know it was pretty controversial. I didn't know that was why, but I could see like that would be one of the key things that might make some people huge fans and some people more conservatively say no.
His controversy has come in the last, 15 years, mainly around precious metals and cryptocurrency and that sort of thing.
He's actually gone the opposite way. I mean, Robert Kiyosaki's always calling doom and gloom around every corner. In this case, he was like Mr. Pedal to the Metal. Buy that and flip inexpensive houses.
Yeah. Real estate was the major.
Those were his two solutions.
He's the one that's famously said online, if you owe the bank $10 million, that's your problem. If you owe the bank $1 billion, that's their problem.
Right. That was just a few years ago.
I'm sure other people have said that, but he's made famous with that. But the central thesis of Rich Dad, Poor Dad, I think, is instead of, and this is one of the analogies that I remember from the book. Let's say that you wanted to buy a sports car, right? You're 40, you're like, hey, I'm just going to get me a Porsche. and they're $50,000. His point was, don't go take $10,000 out of your bank account or $20,000 out of your bank account. Go get a loan for $30K on this, sports car. Instead, take $20,000, go buy a $200,000 rental property that is going to kick off $700 a month of profit. That's the car payment that you have to get. Basically, flip it around. Instead of buying things that are depreciating, buying things that are going to cost you money, take that money, invest it into an asset that's going to produce a return, and then use the return for consumption. Like, because the return will continue if you own the rental property in theory, right? You get the $700 forever. Eventually, that cash flows out positive and accounts for the car payment.
Yeah. Our friend Alan Corey, when he was on the show, OG, a few years ago, he's now a big time real estate investor. He just hated paying bills. I mean, I love this story. He hated paying bills. So he's like, I'm going to buy a house that will make my electric payment. Then I will buy a house that will pay my groceries. Then I will buy, and he didn't think of it as an asset. He thought about it as another bill he didn't have to pay that the asset would pay for him. So
there was a guy when I was an early planner at American Express, and you would know who this is, Joe, and I can't remember his name now, but he was in Detroit. He was an older planner, had been around for 100 years. And those were back in the days of commission products. And I remember him talking to the younger advisors, like, don't let anything go. If your client could use a 2-year CD, make sure they buy that 2-year CD from you. And somebody said, oh, well, that's not a big deal. That's only, $1 commission a month. Like, who cares? And he pulls out his statement, and maybe you've even told this story too. So maybe he used this more than once. But then he pulled out his comp statement and said, well, these $2, see, I've done 10 of these. That's $20. That pays my electric bill. And then here's this page, and here's the 10 of those that I did, and that's $200, and that pays, that's a great way of thinking about it. Set aside the commission piece, but I'm saying, like, if you can find something that can pay a bill instead of consumption, you can use it from an asset. That's a fun way to think about your lifestyle.
And I think that's why so many people are attracted to real estate, which is why I want to pivot, because real estate is in our second headline. OG. This comes to us from CNBC. When Invest Like the 1% fails.
God, I love this article.
A famous piece.
I really feel like this is I Told You So.
From 2025. How Yield Street's real estate bets left customers with massive losses.
Can we go back? Can we check tape? Can we do this? Is there like a search function in Stacking Benjamin's archive?
Yeah.
Like 2019, when we're like, this is a scam. Don't do it. And I remember people writing going, oh no, I'm getting all this cash. It's really great. Like, we've seen this movie. It ends badly, but carry on. Tell us how it goes, Joe. Tell us how it goes.
Well, I don't recall us pointing at Yield Street, but we did point at one of their competitors.
Oh yeah. Fundrise. They're all the same.
Fundrise. We 100% pointed at Fundrise. And by the way, Fundrise is still around. I don't think Fundrise is a scam, but I do think that
100% it is. It's just like this.
Deceptive advertising.
Absolutely.
Just incredibly deceptive advertising.
Yeah.
Far riskier than I remember on the front page, OG, remember it said engineered for superior results. I'm like, oh, every other real estate investor is engineering for mediocre results. You've got this asset that's old as time, and you finally picked the lock on something that people before you weren't able to do, really? So this is the piece. When Justin Klisch stumbled upon an ad for Yield Street back in February 2022, he said it was the company's tagline that stuck in his head, right? Engineered for superior results for Fundrise. This one says, invest like the 1%, the startup said. The ad spoke to his desire to build wealth and diversify away from stocks, which were then in free fall, Klisch said. Yield Street says it gives retail investors such as Klisch access to the types of deals that were previously only the domain of Wall Street firms or the ultra-rich. So Klisch, 46-year-old financial services worker living in Miami, logged onto the Yield Street platform where a pair of offerings jumped out to him. He invested $400,000 in 2 real estate projects, luxury apartment building in downtown Nashville, overseen by former WeWork CEO Adam Newman's family office.
That'll go great.
But at the time, that seemed like a layup. 2022, WeWork is hot.
Oh, wait, it was in 2022. I got to find the book.
Was it already gone in 2022?
Absolutely.
My God. And 2000 was like 4 days ago. Did we say that? and a 3-building renovation in the Chelsea neighborhood in New York. Each project had a targeted annual return, wait for it, of around 20%.
Yeah, by the way, Adam Newman resigned in 2019.
Shut up. Really?
Yeah.
Oh my God. Where does the time go?
Yeah, it's a good docudrama that you can watch about that.
Yeah. The other interesting thing about this piece here is the TLDR is they ran out of money. They're running out of money. They've never had money. Everything is getting eaten up in fees. There's no liquidity. And so they changed their name. They just went, no, we're just a new company now. I remember reading some piece about it where it said, it's more encapsulates what we're trying to do. It's definitely not the fact that we've completely destroyed the lives of thousands of investors across the country and our name is really, really bad. But it's definitely, so what is the new company name? Willow. Okay. The more things change, the more they stay the same. I think that was the theme of your show today, Joe.
Well, let's talk about this. Can we just start at the beginning here? Invest like the 1%. Like, you don't want to invest like the 1%.
Well, and I was thinking about that because we're at the beginning of a year. Everybody's making their forecast for what the year's going to be. Last year, market was up pretty good, 17%, the S&P. Internationals were up bigger. Maybe this year's minus. And anytime that there's any amount of variability in stock prices, even if it's just a short-term decline, like, we saw a couple times in 2025, out of the woodwork comes the marketing pitches of, you don't have to take this. You can get better returns without all this nonsense of volatility. And the reality to that is that there is no way to do that. Period. Full stop. There is no way to have stock returns without stock volatility. It doesn't exist. So if you're getting stock returns, or if they're advertising stock returns, then you have to be getting stock volatility, because the entire universe of people who invest, the hundreds of trillions of dollars that trade on the open market in every economy in the entire world, if there was a better thing than stocks, they would, the universe would do that. You know what I mean? Like, you have to believe that there's not this one thing that, we're just going to keep this a secret because we don't want the 99% to know this. So we have this double secret thing that gets way better returns with no risk. It doesn't happen in real life. It doesn't happen. Everything else is just purely playing on the volatility or fear that people have of volatility, which, by the way, is the reason that you get the returns that you get. Like, that's the trade. That's the trade. You have to be okay with waking up in a year from now and having 20% less in your portfolio. That's just the deal.
If you buy a stock for a nickel, which stocks trade for a nickel for a reason, and they're delisted for a reason. They're penny stocks on the pink sheets. Don't need to go into all the definitions of what that is, but it's because it's a little tiny company that you might own 10% of with just a few $1,000. Yeah. That's a risky bet. And so by increasing your what's called standard deviation, the ups, downs, you can make a killing. But the inverse then is also true. You can lose your ass. You will 100% lose your ass, or you'll make a killing. And you know what? You're not going to have to worry about it either way.
Everybody's into gambling apps these days, right? I mean, it seems to basically be all the rage. So, when you go look at the football game that's this weekend, or the NBA games or something, you can build out a $10 bet that pays out $1 million. You can say, if this team wins, if this guy has this many points, if this guy has this many touchdowns, if this guy throws this many interceptions, if this guy does this guy, you could just keep adding all of that stuff to it, right? And the bettors or whatever, the casinos will say, we'll take your $10 against $1 million for this range of things to happen. That's the same thing, Joe, as what you're talking about in terms of volatility, standard deviation, using a fancy word. You're saying, I'm going to take $10, I'm going to turn it into $1 million. Okay. Yeah, that's doable. That's doable on DraftKings. You can build out that bet. You can even build it out where you've got in your mind, a high likelihood of getting it. It's doable. What do you think the math wizards at DraftKings have figured out with your $10 bet?
Is that your math skills are not strong.
They're not as good as theirs. They've got it figured out that we can take this $10 because we're going to take $10 million of $10 bets like this before we have to pay one of them out. It's probably more like $100 million of bets like this before we pay one of those out. You know,
we did this story a long time ago and you're not hearing it anymore, but it's not because it doesn't exist. Remember the story we did a few years ago when these apps were just becoming big about how DraftKings had built these algorithms that were actively taking the other side of bets that were horrible bets that stupid people were making. So stupid person on one side, they built an algorithm that jumped in and bought the other side, which had a much higher likelihood of winning the bet. Really interesting. You know, that still happens today. I mean, that's a huge, huge part of these apps is just preying on the stupidity of somebody who wants something for nothing.
I mean, it's not to say that to your point, it can hit, right? There's the stories that you read about on Twitter, the guy that put $100 on this guy to win the Masters, this guy to win the World Series, this guy to win the Super Bowl, this guy to win the NCAA basketball championship. And there are 3 of those 4 in, and their team's playing in the World Series, you know? And it's like, it can happen, but it's like this one guy. If it happened all the time,
somebody in Arkansas won over $1 billion a couple weeks ago.
Must not have been you because we're still here.
Damn it. I live 800 yards on the wrong side of the border.
Joke's on you. I did win and I'm still here.
Would you tell anybody? Cheryl and I talked about that. Would you tell anybody at all? I don't think you could tell anybody.
Like my son said, because my oldest and I were talking about this because, you know, I'm sure you guys put $1 or $2, whatever it was in Powerball. Alex goes, what do you do if you win? And I said, well, you know, we talked a little bit about not telling anybody. He goes, oh, I wouldn't tell anybody, but there would be signs.
There would be signs.
He's like, I might show up to school next week in a Ferrari instead of my Nissan Murano or whatever.
What happened? Yeah, that's great.
The moral of the story, back to the stock piece, is you're going to hear more and more of this stuff. If 2026, I'm just telling you, if 2026 has any amount of volatility in it, which inevitably it will, you're going to hear about how gold is the only hedge against inflation. You're going to hear that you can protect your downside with buying annuities. You can invest like the 1% and have all these cool things that only rich people know about. And it's all, what would Grandpa call it? Malarkey. It's all malarkey. So
love that term.
Put your money in the market and don't touch it for the next 100 years, but for God's sake, you could be like a Rockefeller.
Well, coming up in the second half of today's show,
your kids or grandkids.
I do want to dive into that, OG. In the second half of today's show, we're going to talk about, we talked a lot about what you shouldn't do. Let's flip that script. What should you do? We're going to talk about 3 big $100 terms: asset allocation, asset selection, tax strategy. We're going to have OG put those in order for us later on. We also have a TikTok minute with another lesson about real estate. I know OG's really excited about going back to TikTok because he loves it so much. We're going to dive into that. Before all that, we're going to take a quick break here because Doug's been warming up in the wings, man. I love the jumping jacks over by the hot water heater.
That's crazy that you just used that and shared that, Joe, because I was playing categories recently over the holidays with people that were in, and the letter was J, and one of the categories was things you do every day. And I wrote jumping jacks, and it got struck down.
You're kidding me.
Yeah. I'm like, there are people who do jumping jacks every day.
Jack
LaLanne. They didn't believe that I was one of them, but there are people.
Is that a name from the past? Is that just, I remember being like 25 going, that dude's old.
And ripped.
Right.
You could hope to look as good as he did.
Yes.
But that jumpsuit, man, he looks sweet in that jumpsuit.
Imagine Jack LaLanne doing jazz hands. Speaking of J words.
It was a little awkward in that jumpsuit. It was a little awkward when he reached above his head.
Yeah.
And
stretched it all out.
Stretched in ways you didn't want that to Jack. Put the hands down.
What do we got today, Doug?
Hey there, stackers. I'm Joe's mom's neighbor, Doug. And remember last year and that awkward thing that we're definitely not digging back up again? No, I'm not going to tell everybody what happened. Both my lawyer and septic tank guy forbid it. But 2026 is not going to be like that, is it, stacker? You're going to step up. You're going to press on the gas. You're going to show them all. Hold on, you know what? Who cares about them? You're going to show that person who's most important, that person in the mirror staring back at you. Awkwardly because you're in a public restroom. That's right. You're going to show the number one person that this year is your year. Let's tackle the new year like a boss, shall we? And we'll get started with this because today is the anniversary of the day the boss, Bruce Springsteen, released his first album, Greetings from Asbury Park, New Jersey. If you purchased a signed copy on the day he released it for $10 and sold it today for $10,000, what is the name of the tax that you'd have to pay on that sale? Of course you know this. I'll be back right after I go tell Joe's mom just how much you're going to rock 2026.
Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you.
This episode is brought to you by Progressive Insurance. Do you ever think about switching insurance companies to see if you could save some cash? Progressive makes it easy. Just drop in some details about yourself and see if you're eligible to save money when you bundle your home and auto policies. The process only takes minutes, and it could mean hundreds more in your pocket. Visit Progressive.com after this episode to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Hey there, stackers. I'm Guy who totally believes in you and future motivational speaker, because, let's be honest, Joe's mom's neighbor, Doug. The boss, who's only second to you in my book. You're totally the boss, but he, somehow got the nickname first. Maybe we'll call you like the chief from now on or something. But the boss released his first album on today's date in history, and a legendary career was born. Just like you're launching something here in 2026, right? You and Bruce Springsteen have so much in common. If you'd bought Bruce's first album way back in 1973 for $10 signed and sold it for $10,000 today, what is the name of the tax you'd have to pay on the gain of $9,990? It's called the capital gains tax and applies to most assets you purchase. One notable exception, your primary residence is excluded from the first $250,000 of gain if you're single and $500,000 if you're married filing jointly. But remember, this only applies to your primary residence. See, you're already thinking of ways to rock your taxes in 2026, aren't you? And now, your wingmen on your quest to better money habits this year. Definitely not your wingmen in the bar. Back to Joe and OG.
Why not? We'll help you out. We'll help a stacker out.
I've been in the bar with you. Never once has it been a good night.
See that one over there? We'll help you out. Yeah. With terms like malarkey, like we flew out of our mouth the first half of this show, what could go wrong?
You're not thinking about any shenanigans with this fella over here, are you? You don't want to engage in any tomfoolery with him.
That would be a hootenanny. Let's do a TikTok minute. Our TikTok minute is the part of the show where we dive into a piece that a creator on TikTok or another social media platform made, which could be either brilliant or air quotes brilliant. Doug, our first one of 2026, Tina from our team found this one. This is real estate we're going to be talking about.
Oh, yeah. I mean, if it's coming from Tina, she's money. She's amazing. So this thing is going to be, you're going to change the direction of your life based on this one right here.
I don't know about that.
I'm pretty confident.
You could have gone from motivational speaker to overselling it slightly when you hear it. But I will say this is interesting. And Tina actually pointed this out. She goes, some people know this, but for first-time home buyers, and if you're buying your first house in 2026, I think this is a valuable lesson to learn about how you talked about capital gains taxes, Doug, and capital gains exclusions. You also need to know when you're buying a house about this little thing called real estate taxes.
Now, this is the section that saves people thousands. How your taxes are calculated depend on whether you own the home or you're buying it. If you already own a home, your taxes are the taxable value times the millage rate. If you're buying a home, do not trust the seller's tax bill. It's capped tighter than your jeans at Thanksgiving. Your future taxes will be based on the SEV times the millage rate because the home uncaps at the sale. That's why the seller pays about $2,800 and you suddenly owe $4,600.
Yeah, don't trust in a lot of states where that tax is capped and is going to go up slowly, OG. Don't trust that. When you're buying your house, that tax bill for you may be significantly different, as this gentleman said, than what it was for the previous homeowner.
Yeah, definitely state specific. That accent was very, very, very Michigan. So
very Michigan,
very Michigan.
And he didn't say anything about people freaking out when they get that letter every year that says tax and their home value is like $9,000. And they're like, oh, I sold my house for a lot more than that. It can be confusing.
I got crushed last year on just property tax. I was like, are you kidding me? Really?
There's no limit on how much it can increase in Texas?
Well, yeah, there is.
There has to be.
It's a comical limit.
I think it's called the sky's the limit. The sky's the limit.
There's unlimit. No, basically in Michigan, and maybe this has changed, but the last I remember in Michigan, the max increase was 3% in your
I think that's right,
taxable value. So, and this is what the guy's talking about here in this video. It's like, let's say that you buy your house for $200,000 and you live there for 15 years. And the house price is going to, bounces around, right? Some years it's worth more, some years it's worth less, whatever. But the most that the state can increase your taxable value is that 3%. So your tax value is $200,000 because you buy it. But then in year two, it's $206,000. And to your point, Doug, you're like, well, wait, my house is worth $250 now. It's like, I know, that's cool. But we're only going to tax you on $206. And next year it's $212 or, whatever the 3% number is compounded. That leads to some problems because you have this slowly rising property tax bill. And like the author of the video said, when you list that online, it says, how much are your taxes? You go, oh, we paid $2,800 because I've had this small increase. But now I sell the house for $500,000. It gets recalculated and you start that 3% over at the $500K. In Texas, the limit's 10%, but it's cumulative. So if this year is 20, they go, oh, well, we can only use 10. And then next year's 0. They go, oh, but we had 10 from last year. So it's 10 again. So they can hold on to previous year overages to fill up last year's bucket or this year's bucket. So it gets pretty high. But the current proposal, one of the proposals by the sitting governor as he's trying the reelection, it's also happening in Florida, is they're trying to give the power to the localities to decide whether or not they want to even have property tax. The proposal is to put it back on the localities to say, do we even want to have property taxes here?
It'll be interesting to see what happens next.
I mean, there's some arguments about this. Obviously, you pay your house for 30 years, and now you still owe $20,000 a year in taxes to live at your house. So different topic for a different day, I suppose.
Absolutely. But big thanks to Tina for sending that in. Well,
TLDR, property taxes suck. Yeah. And this is the time of the year when you pay them.
Well, and you do these projections though, you do these projections on what you think your cost is going to be around your house. And you forget property taxes in some states might go up. You forget maintenance costs. You're going to go in. Oh my God, every time I've moved Home Depot, I feel like I need a frequent flyer card. Like, oh, do you have a priority lounge at the back of Home Depot for your customers that come here a lot? You walk in like that old show Cheers. Norm, it's like, Joe, hey, you're back for the 47th time today. People forget all of these other expenses when you purchase a new property. We talked in the first half of today's show about what you shouldn't do with your money. I want to pivot that because we're not the show about what you shouldn't do. We want to talk about what you should do. And I think the number one thing that we talked about here, OG, was diversification. Diversification matters. Having money in a couple of penny stocks or in a couple of yield street properties, probably not a great idea unless your primary goal is to get rich quick. If your primary goal is to get rich quick, then don't diversify. But otherwise, if your goal is to get rich off of your income stream that you bring in, then do something safer with your money.
Well, I would challenge you on if your goal is get rich quick, because the reality of investing in penny stocks or virtually any sort of alternative anything is most likely it's get poor quick. I don't think that get rich quick actually exists other than luck. By all means, if you want to try the luck bucket, you can. I was talking to a pilot the other day. We were talking about flying in some challenging weather, and I was reflecting on this quote that I heard, or some variation of it, which was something like, you have a luck bucket and an experience bucket, and your goal is to fill up your experience bucket before you run out of your luck bucket, when you're flying.
Yeah.
So, because, sometimes you use some luck and you're like, oh, that was a bad idea. But I think the same thing is kind of true with investing. Sometimes you're going to make a mistake and it's going to pay off. I think like the investing that we did when we bought the rental properties in Michigan and we had the apartment buildings, I think that was more luck than it was experience and efficacy. I mean, we bought a really dilapidated property that had some decent cash flow. We put a bunch of money into it, and then we got lucky that COVID hit and drove the price of the property up by 250% in a year and a half. And we got lucky that there's some other idiot investor who was like, oh, I want to buy all these things in the street. Like, this sounds like a good idea to like corner the market here. Then I got lucky because I knew the realtor who sold the other deal, and I called her and said, hey, I'd be interested in talking about it if your investors interested. And she was like, I've got just the dumb investor for you. And we got out. And then the thing, I don't think that was because we were some magical investors. We got lucky. We got lucky on the timing, unlucky with COVID, but just how it turned out.
Well, sure. But because that's one property, so I
got rich quick. It wasn't because I was good.
No, but the standard deviation on that deal is because you own one and not 10. If you had owned 10 of those properties, you would have taken your luck and it would have mitigated it down to more the mean, and you would have had less chance for that serendipity to actually hit. I mean,
so there is no such thing as get rich quick. It's get lucky quick.
Well, let's talk
and you
about
happen
this
to make
though.
money.
Right. But this is all still about volatility. And I think that, if we take it the way that more real life example than betting the lottery or betting on a single apartment building, you can own 5 stocks or own 5 funds. 5 funds, each one's going to have between maybe 150 to 1,000 different companies in it. So you're going to own a lot of different stuff, or 5 individual companies. Your portfolio, even if they're all big companies, OG, it's going to go up faster. It's going to go down faster in a normal market owning 5 stocks than owning 5 funds.
Yeah.
I think diversification truly for the average investor who doesn't want to follow 5 stocks or trust serendipity is going to be the way to go. But I do want to be clear here. A lot of people listen to shows like ours because they want to find ways to get rich more quickly. And you are eliminating some of that serendipity in order to get some more certainty. by all means, you're not buying certainty, but you are buying the economy. You're buying the long-term ability to grow your money in exchange for this volatility that is going to, wipe out most investors.
Well, I mean, to some degree, I think you are buying certainty if you give it enough time. I think this just boils down to a person understanding or being okay with the fact that the power of compounding, the power of market returns, you can't see in advance. Like, you just have to experience it. And I think that more people try to take bigger risks once, or if they feel like they're behind the 8 ball.
Yeah.
And I want to just preach the message that you're not behind. You have enough time. And if you're 50 and you haven't started, like, are you going to retire at 55? Probably not. Like, you're not going to probably do that unless you make an insane amount of money and change your lifestyle magically. But you still can retire at 65 or 70. Like, 15 years or 20 years is still a long freaking time. You have to do some work, right? And if you're 30 and all you're seeing are Instagram posts of people on JSX flights and you think that they're all flying private and you're like behind, you're not, bro. Like, 30-year-olds do not have money. There's a few that do because they got lucky or because they got in at the right job at the right time and did the right stuff all the way.
Which was pretty much the right thing to do, is to buy a ring light and tell everybody how wealthy you are.
Yeah, in some level. But again, it's like, if that person from 22 to 30 maxed everything out and lived within their means and like avoided all the temptation of being in your 20s, then yeah, that person probably at 30 has some good money.
Doug, I've got a question for OG about order of operations, but you had your hand up.
Yeah, I mean, just, regular guy question over here. What's a JSX flight?
Yeah, that's nothing that you people in Michigan have. Don't worry about it.
Okay. All right.
I don't even know what a JSX flight is either.
Yeah.
I'll just slink back into the corner.
The backwoods of Texarkana don't have it either.
No.
JSX is a airline that flies Embraer 175s, I think. And basically they took out every other seat.
Every seat's first class.
They fly to select destinations out of Dallas and Miami and New York and LA and Vegas and whatever.
Destinations I probably have never been to nor will never be to.
I don't know. Sounds fun.
I mean,
let's set that as a goal. But my goal here before we finish this up, guys.
What I was making fun of was not the actual flights themselves, but people who take pictures on the flights going, look, yes, I'm flying private. It's like, no, you're not.
No, what's even better are those people that rent the fake airplane on the set in Los Angeles for X amount of money per hour to pretend they're on that flight. That's who we're making fun of. There are 3 different big terms that investors are going to hear this year, OG. One is asset allocation. That's how you diversify appropriately toward your goals. Next one is asset selection, choosing the right actual investment, right? I saw a post just this last week on social media saying, actually in our basement Facebook group, somebody saying, hey, I've been buying the total stock market index. Is there something else that's more, quote, popular, I think was the term that I should be buying? Well, and I actually loved it. Our stackers actually helped this person, saying popular is not something that you really want to use, to get there. So I thought that was really helpful. Shout out to Rebecca who did that. Is it diversifying correctly first, buying the right investment first, or is it your tax strategy first? Like having the right Roth or pre-tax or type of investment for taxes. Can you put those 3 in order about the way we think about them? Which one should we think about first, second, third?
I think that the first thing that you want to do is you need to make sure that your investment goals and your investment return is lined up with what stuff you have. So what I mean by that is when you look at the goal that you're trying to accomplish, if we're just using retirement and financial independence as a goal, let's assume that's out in the future. We need investments that have long-term growth potential out in the future. And so that's going to eliminate some things from our selection list, right? Because we've got a big bucket of all these things that we can pick from. So you're going to remove things like cash and short-term fixed income and things that don't behave in a long-term or don't belong in a long-term, investment bucket. So asset allocation, I think, is clearly number one, making sure that that's in line with what your expected return is or your needed return for your goal.
Yeah. And before you go on from asset allocation, I love your way of thinking is it isn't so much about picking the right thing as it is about avoiding the wrong thing. Look at your portfolio. I remember when I was a financial planner, just going, this doesn't fit, this doesn't fit, this doesn't fit, this doesn't fit.
Yeah. And how many times, Joe, did you meet with clients, and how many times does our team meet with people that have cash sitting in their retirement account or short-term fixed income? It's like, well, I wanted to be diversified, so I picked the the stable value fund in my 401k. I mean, I guess by definition, you're diversified, but you're also using the exact wrong thing for the time horizon. Diversification isn't about like picking one of everything. It's picking between the things that are most appropriate for the time frame of the goal. If you add something that doesn't belong because the time frame of the goal is incorrect, just flip that around. Think about it the other way. You wouldn't diversify your cash reserve into technology stocks, right? You wouldn't say like, well, I got to be diversified. So, I mean, I got to take my emergency fund. I can't all be in cash. I got to diversify it. Let me get some, let's go Alibaba, right? You're not going to diversify that way. Why would you do it the other way?
Because it's way too volatile. Yeah.
So if the first one is asset allocation, then the second one is definitely going to be of the things that are left from your asset allocation. Now, what are you going to use? Big companies, small companies, US based ones, non-US based ones. And I think that for most people, you can get away with really kind of 4 or 5 buckets at most. US companies, non-US. So that's kind of 2 buckets right there. And then in those buckets, big companies, small companies, big companies, small companies. That's 4 buckets. And you get to pick. There's no right or wrong answer to do this. You can use some math. You can use Portfolio Visualizer to get an efficient frontier calculation, but that's always backward looking, right? So that's just going to, you can add, well, what about fixed income? Okay, cool. What about real estate? Okay, cool. Like you can add complexity to that, or you can look at say, well, my S&P fund has some real estate holdings in it. So, I'm kind of getting some exposure there and good enough, fine, easy peasy, lemon squeezy.
I think this is the part people overemphasize is asset selection. Well, it is. But once you get to the fact that you're like, okay, I want to own an exchange traded fund. I want to own a diversified position that some trader's not trading in and out of, that I'm buying and I'm holding, which says exchange traded fund all over it. That's the type of investment that does that. Once I know that, then people are like, oh, do I buy the Vanguard one? Do I buy the Fidelity one? Do I buy the iShares one? Do I buy the pick one? Pick one. I think people spend so much time going, do I buy the S&P 500 through this company versus through that company? You can waste a ton of time where figuring out what doesn't meet the goal or what the tax strategy is. To me, those are far more important things than whether you choose the iShares IVV versus the Vanguard, version of the S&P 500.
100%. Pick the one that suits whatever company you're at.
I think then OG tax strategy is a little bit like asset allocation, where your tax strategy, it's more make sure that you're not messing this up by having money you can't get at it. Like, oh, I over optimized and now I've got cash in this tax bucket that doesn't really meet my goal.
Well, this one's far down the line, in my opinion. I think far too many people will focus on tax stuff when it's completely unnecessary. Famously, Dave Ramsey has this conversation with people about, well, I can't pay off my house because I got to get my tax deduction. And he very astutely points out, you recognize the interest that you're paying to the bank is more than the tax deduction you get.
It's like people chasing reward points on their credit cards and carrying balances.
What do you want more of? Money? Or, it's like, I was having a conversation with somebody, I don't remember who it was now, but they were talking about making a charitable contribution at the end of the year last year, right? At the end of 2025, you're like, I gotta lower my taxes. And it's like, okay, cool. Are you charitably inclined? They're like, well, I mean, if I donate $20,000, I get a tax deduction. I go, absolutely true. Yeah, of like 10,000. So do you want 20 grand in your bank account or do you want 0? Well, I don't really want to give money away. I'm not really charitably inclined. It's like, well, then pay the taxes. Like the tax bill you end up with $17,000 in your bank account instead of zero, by paying taxes. So pay attention to what you're doing from a tax standpoint for sure, but don't let the tax tail wag the dog, obviously. I would look at very easy things to do here. I would make sure, if possible, that my long-term growth things are in my Roth IRA. There's a downside to that. The downside is that there can be long periods of time where the thing that's supposed to grow the fastest doesn't. And that can be really frustrating when you're like looking at your IRA and you're looking at your Roth IRA and you're saying, well, I did it right. I put the really aggressive stuff in my Roth, but it's not, it's averaging 5%, but my regular IRA is averaging 10. Like it should be the other way around. Like I should be getting 10 or 15 in my Roth. So again, when you put specific asset classes, they're not all going to behave in the same way at the same time. So you got to be careful with that. I think that you want to put your things that pay dividends instead of interest in your brokerage account. I like dividends. I think they're spendable. I think they're taxed favorably versus things that have interest, which is taxed at a higher rate. I'm okay with not having that in my taxable account if I need to have cash-like returns or interest-like returns in my traditional IRA. So I think that there's an opportunity there. Far more is made on the strategy of tax deductions and of capital gains and forward-thinking brackets than there is, I think, in making sure that my small cap value stocks in my Roth.
Yeah.
That's a piece, but I think it's a very, very, very small piece. Tax planning is well beyond just asset location, which is what we're talking about here, and way more on like forward looking, like how do I qualify for the correct Medicare when I'm 65 and I have all this money and, I don't want any surprises. That will save you far more money in the future.
If you want to dive more into topics like this one, our own Kevin Bailey writes our 201 newsletter that takes these 101 ideas, dives in deeper with curated links to the best that we find on the internet. StackyBenjamins.com/201 gets you our free newsletter, comes out every week. And you also find out when we're going around the country in 2026. We have just a few things on the calendar right now, but that'll be obviously developing. And we generally try to make it to several cities every year to have some fun times celebrating with our community. Speaking of celebrating, Doug?
Tucson, don't give up on the group in Tucson. I'm coming to you. If you get your act together.
He just wants a burrito.
Coming.
We're wants
going
a
to Tanya's 33.
Burrito.
That is a deal breaker if that
Tucson,
doesn't happen.
you're being used. You're being used by Doug.
But I will be there. I will come to a meeting if you guys can get your act together. Now we need at least 5 people in Tucson to get me there. But
right.
I'm
if
gone.
those 5 people tell 5 of their friends, and then they tell 5 of their friends, the original 5 people get their burritos for free.
Yeah, it just reduces the amount each one has to contribute to buy me a burrito.
Well, as we're celebrating, we end every show, if you're new here, by celebrating our community. We talk about what's going on in the neighborhood. We've gotten some interesting notes from our Stacker community, Doug.
Yeah, Joe, we got some great ones. Stacker Gary shared his Spotify Unwrapped results. Just want to provide my Unwrapped results. He says, Stacking Benjamins was my #1 podcast on the Spotify 2025 Wrapped this year. After listening to over
That's fantastic.
After listening to over 7,914 minutes, I can't believe I haven't learnt anything. He says learnt. I never know when to use that, but I'm impressed, Gary. He hasn't learnt anything. Thanks for the greatest show in finance. And by the way, I'm a little confused about the Kit Kat. Which side is better? Mine has one side bigger than the other. Does that mean anything, or just for Doug? I corrected him, Gary. He had it wrong. It isn't the Kit Kat, it's the Twix.
It was the Twix. It was the Twix. You wonder if Gary's got a Twixt as well.
Right.
Maybe. I don't know.
Are you a left side or a right side?
We had a lot of people share their Spotify Unwrapped, and it's so thrilling to see some of our stackers spending so much time with us this year. Thank you so much for trusting us with your time. We know that it's valuable. And I love the fact that this year, speaking of Spotify really stepped up with the ability for us to talk to people there and chat back and forth. I know we can't do that on Apple, which is really frustrating when somebody leaves us a review and I'm like, I can tell you why we were thinking that. You might not like what we were thinking, which I can appreciate, but I love the fact that we can chat about the show and some of the making of the show and what's going on in the community. I'm going to try in 2026, and the key word here is try, because you never know what's going to happen, but they give us the ability to post polls. And so we can put up polls, we can ask questions. I'm going to try to do that more in 2026 because I really enjoy the back and forth. I love it when we get replies to the stuff that we do here. It makes it really fun to create new episodes. So thanks for that, Gary. And thanks to everybody who shared their Spotify Unwrapped. So cool. We actually did our own version of Unwrapped in the 201 last week as well, about some of the crazy statistics and stuff that happened here in Mom's Basement.
Yeah. Joe, I'm hoping you can help me with this next note we got, though. I don't get it. I'm a little confused by this. I don't know what caused this note, but I need everybody's help. Shane sent a very curious note that says, next year, Doug and the three ghosts of diarrhea past, diarrhea present, and diarrhea future.
I think he's talking about OG's grandpa and his toilet paper solution that was kind of gross.
Oh,
but that we ended 2025 on a really shitty topic. I think that's where Shane was going.
Oh, I forgot all about that.
Had nothing to do with diarrhea, as I recall.
It did not. No, but just imagine how that ruins your grandpa's plan. Just, I guess,
thanks, Shane.
A couple more things about that episode, which is for people that are new here, an annual episode we do around holiday time where we talk about the mistakes of the past and the present and having a better future. Doug and the three ghosts. Chris, who apparently lives up the road from me in Little Rock, Chris wrote perfect weather and location for listening to the three ghosts. He's got a highway sign that says headed toward Texarkana and Dallas near Hot Springs. So not that far from us. And it's gray and it's overcast and he's listening to it with the perfect weather as he's driving down the road.
That was a cool post.
Yeah. And another stacker, Matt, had some commentary. You know, we talked, OG, on that episode about, especially when you're in debt and you're just starting out and you want to take a vacation or do something really fun, prepaying
Tough.
Right. And prepaying for pieces of it makes it so that you don't get into a ton of debt like I did the first time I went to Disney. We talked about the second time. I prepaid a piece at a time. I bought my tickets at a time. I bought the hotel rooms. Like I slowly built up, and then we had a completely prepaid trip. And he talked about how prepaying is so enjoyable for him. And it makes everything so much easier since the first time he heard Doug and the Three Ghosts a few years ago, which is great. He likes the fact that we got to remember that.
It was like you were playing categories with us, Joe, because that also came up. The letter was A, and one of the categories was things you save up for. And I wrote admission to Disneyland.
And did they vote that one down too?
It was controversial.
It sounds like a mean game of categories you were playing.
Oh, it was heated. We had to bring in an independent judge. It got heated. We had some great ones. Here was a great one. I think the letter was M and the category was states. My son wrote matter.
Oh, I would have put mass confusion.
Yeah, I know. Slow clap. People wanted to argue it, but we're like, damn, that's good.
Yeah.
Or we had another one, wireless things, and the letter was elephant, or the letter was E, and somebody wrote elephant.
Oh.
There's no wires in an elephant.
No. That's so good. Well, thank you for the notes, everybody. Please keep those coming, whether it's on Spotify, notes to me, joe@stackybenjamins.com, or in Mom's Basement, our Facebook group, where our friends who hang out together share good money tips, some dad jokes, and thoughts about the episodes. All right, that's going to do it for today, except this. If you want to start off 2026 with a bang, what a better way to do it than spending time here with us today. But if you need more help and you need good people in your corner to help you out, OG and his team of Anna and the rest of the team at OG's firm, they're taking clients. So head to stackingbenjamins.com/OG to get on their calendar. You want to do that early this year. So 2026, you're kicking it off on the right foot. All right. We end each episode by asking Doug, of all people, we asked Doug, what should we have learned on today's show?
It's not the direction most people would go in.
May not be what we should have learned, but Doug, what do you think?
What did I learn? Well, Joe, first, take some advice from today's headlines. 2026, different year, but the same basic rules will still apply. Second, did you hear my first lesson, but still think you want to peek at an IPO or invest in some hot real estate scheme? Get your hand out of that cookie jar, or Joe's mom's going to whack it with a wooden spoon.
Ouch.
Probably that one that has the nail through it.
No,
anyway, but the big wow.
You just went too
she's
far.
Got it. It's there, dude.
It feels like it, but I don't think so. That would be cruelty.
She's a ninja with that spoon. But the big lesson? I can't believe I compared you to Bruce Springsteen earlier. I mean, you're way better looking than the boss. Maybe, pretty much everybody is, but maybe like Taylor Swift is your spirit celebrity or no. I got it. Ryan Gosling. Oh, you think you're more handsome than Ryan Gosling? Okay, maybe Jonathan Bailey? Beyonce? That's it. You're the Beyonce of personal finance. Even Joe's mom can get behind that one. Now go tell all your friends. Thanks for kicking off this year with us, Stackers. Come join us and our first mentor of 2026 on Wednesday when the Laura Vanderkam joins us. She'll share her time management secrets to help you accomplish more and enjoy more free time all year long. This show is the property of SB Podcast, LLC, copyright 2026, and is created by Joe Saul-Sehy. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. And oh yeah, before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.
Well, I went and saw one of the movies, guys, that is supposedly when the movie's up for Oscars this year. And I like seeing all of those before the Oscars come out. This is a movie starring Timothy. I pronounce his name wrong all the time, Doug. How do you say it?
I love this. It's Champs-Élysées is
Timothy
Champs-Élysées.
Also, I call him Timothy Chalamet, but it's
just Chalamet.
Timothy Chalamet.
It's just Chalamet, like Shalimar.
Timothy Chalamet,
that great group from the
Gwyneth
80s.
Paltrow, and we're going to talk about another guy who's in this movie here in a minute. But this is Marty Supreme.
I have a purpose.
Okay. Let me ask you something. Do you make money at this little table tennis thing?
Not yet.
Do you have a job?
No. Backhand! Backhand! Forehand!
How do you live?
Well, I live with the confidence if I believe in myself, the money will follow.
And what do you plan to do if this whole dream of yours doesn't work
That
out?
doesn't even enter my consciousness.
Maybe it should.
That sounds like people who start a podcast want to make a living off it. I have this belief that if I start up, it's always funny when people podcast for 3 weeks and they're like, hey, so how do I monetize? It's crazy. This is a fictionalized account of actually a real life person who is a table tennis star and a hustler, first name of Marty. played by Timothy Chalamet, and also starring one of the people. He actually is as much of a hustler as he is a table tennis player. He does think he has a purpose, which is to be the top table tennis player in the world. He gets shocked the first time that he goes to a table tennis event that he's expected to win. And the Japanese, who recently had not been allowed to compete after World War II in all these different competitions, that ban was lifted. And now they have a table tennis star who kicks the crap out of him. And he's angry and he's frustrated. And his goal is to get back to number one to face this Japanese table tennis star. Gwyneth Paltrow plays one of the people that he takes advantage of during the movie. She had been a movie star. And this gentleman, Marty, the entire movie's taken advantage of people. In fact, he has a run-in with a character played by Penn Jillette. So there's all kinds of people in this movie.
Wow.
Gwyneth Paltrow's husband in the film, and who has a major role in the film, is Kevin O'Leary, the guy who's the Shark Tank dude, who's not even an actor. I've never seen him in a movie. He's incredible. He plays himself. He's a total he's just a complete jerk, like he is a lot of the time on Shark Tank. Kevin O'Leary does a really nice job.
I hear you saying OG has an acting future.
Yeah, I think he does. I think OG, it isn't a leap forward. This is the new you in 2026. Hollywood agents, if you need a star, get them ahead of time. OG.
This is all an act, by the way.
Well, it's been beautiful. You played this part now since 2012. Like, it's amazing. Well, 2011, if we go with the earlier shows that we had. So strongly acted. Timothy, what's his name, is amazing. Gwyneth Paltrow is incredible. Kevin O'Leary is also great. This movie couldn't have sucked more. It could not have sucked more. It was all over the place. I like watching movies with empathetic characters that I want to follow. I hate this Marty dude. I hated him from the beginning. He's scamming everybody. He's trying to get a free lunch the entire time. I want to get out of the movie theater every cringeworthy scene. Take Ricky Gervais' humor, which is very much, oh God, this is a train wreck in slow motion, but make it not funny. Make it schizophrenic, put it all over the place. This movie was such garbage. And I think this is one of those things, Doug, that you and I have talked about in the past with like The Studio, where Hollywood insiders have these great actors. And it's like they know too much about film and they're too much inside baseball. And they're like, oh my God, well, the visuals were great and the acting was great. Yes, all that is a yes. But the story is
Script was horrible.
And who in middle America wants to go spend 2 hours with a bunch of jerks that I don't want to support or believe in? One critic even called this, Cheryl and I looked up the Rotten Tomatoes for this movie. One critic called it a feel-good movie. Feel good? Somebody ripping people off the entire movie? There's a feel-good moment, and I'm going to trust that you're not going to go see this film because I wouldn't go see it. I wouldn't waste any time on this movie, but the last 2 minutes of the movie are feel good. The last 2 minutes of the film, the other 2 hours are complete feel bad about humanity, about yourself, about the fact that you've been taken advantage of. Ugh.
We watched Flight recently, the old Denzel Washington movie where he's an alcoholic pilot.
Upside down plane.
Yeah, he's upside down. And I mean, an amazing performance. You can't call that a feel-good movie except for the last 90 seconds where he reconciles with his son right at the end, or his son chooses to come to him in prison and learn about his dad. But up until then, it's a pretty rough ride.
Did you like the movie, though?
Yeah, it's not my first time seeing it. I do like it. Don't love it. He's amazing. It's really, you made me think of it because great performances in that movie. Kelly Riley, I've forgotten it's an early Kelly Riley appearance from, Yellowstone fame. She's quite good in it. There's a few other really good, and Denzel's just Denzel, unbelievable.
Sure.
But it's just not a feel good movie. It's the great scene at the beginning where he's saving the plane, and cool scenes in the trial towards the end, but just rough, like leaving Las Vegas. right? Amazing performances, but you're like, oh my God, this is killing me. Can we get out of here?
If you've watched Marty Supreme and you liked it, I would love to hear from you. Like, you fight me on this. What did you see in this film? I generally, as you guys know, I agree with the critics a lot. People are like, oh, can't stand that. I kind of follow the critics and like what the critics say and do, and generally enjoy those movies. This one, I was so excited to see. And halfway through the movie, I'm like, when does this end? Does this end anytime soon? Because, oh Lord,